afternoon, everybody. I want to welcome everyone to the webinar. My name is Mark Reibold. I am EVP at Coker. I really appreciate everybody joining us today, and I appreciate my colleagues joining us today. We're talking about ASCs. So the focus today is on surgery centers, a blueprint for buyout, and talking about long-term success and growth of ASCs, as well as some M&A strategies. And we'll talk about a number of things as it relates to ASCs. I want to, in just a moment, I'm going to introduce my my colleagues that are joining me today. But I think one of the things that we do a lot of work with is groups and hospitals and health systems, private equity, corporate sponsors, any type of organization out there that's in the ASC space. We do a lot of work in this area, and we thought it really would be a helpful discussion for our clients to respond to some of the things that are going on, some of the questions we receive, and different activity going on out there in the marketplace. And obviously ASCs, it's a strategy for a lot of different organizations. And so we're going to dig into a number of different things. And before we dive into introductions, I just want to mention we're gonna tackle a number of topics today. This is going to be a fairly informal kind of panel discussion, if you will. My role here is just to kind of moderate and facilitate the discussion. I really am looking forward to some of my colleagues chiming in on some of the different specific topic areas that we'll be covering, and really just realizing that we can't cover everything in the span of an hour or so. There's probably going to be questions, additional information that would be helpful, things that we weren't able to cover. So before we get started, I'll just go ahead and mention, if you guys would like any additional information or have additional questions, topics that you'd like covered that we weren't able to dive into, always welcome feedback, those questions, and additional conversations. We're always happy to have those. So we'll make sure that the contact information is available for everyone here today. But you can always reach out to any of us for that additional information. Coker has generated a lot of content and thought leadership on this topic. And so we have a lot of supporting information. As I said, this is going to be more of a panel discussion. So we're not going to go through a lot of slides. In fact, we really don't have slides. This is going to be more of an interview style panel format. And but in the event that there's something that you'd like us to dive into with more information, again, we can provide that. With that, I want to dive into introducing my colleagues. I'm going to let them spend just a real brief moment and introduce themselves, and we'll dive into the content from there. So, Andrew, you want to introduce yourself?
Yeah. Thanks, Mark. Good afternoon, everyone. Andrew Hranka, Managing Director here at Coker. I lead all the M&A type services that we provide. So what I would consider that would be kind of sell and buy side advisory for physician groups, hospital systems, private equity clients, multi-site focused consumer healthcare. So spent 15 years in healthcare investment banking. What we really kind of focus on is everything. I think we're a holistic advisor here, where we're not just looking at the deal itself, but we're looking at the prep and the optimization at the front end to make sure that your organization is ready for sale, then taking you through kind of a recapitalization type process and additional Coker resources that can help with post-merger integration. So I think it's a differentiated offering, and I think we have all the experience within ASCs and other physician groups to really kind of help your organizations thrive and achieve all their goals. So great to be here.
Thanks, Andrew. Richard?
Hello, everyone. My name is Richard Romero. I'm a Senior Vice President at Coker. I spend a majority of my time dealing with transactions. That includes issues providing valuation services, including issues on what we'd say the business valuation side, compensation valuation, and also expert witness testimony about financial disputes and including regulatory defense.
Great. Wendy?
Hi, I'm Wendy Bruno Thompson. It's nice to see you. Thanks for participating today. I started my healthcare career years ago working with one of the first dozen outpatient surgery centers in the country. And after that, I've just continued to work with ASCs, primarily related to the development, the optimization, making sure that we're performing properly, and then working through the transaction and or merger acquisition process. So I'll be getting into a little bit more of the nuts and bolts of performance and performance optimization, kind of common pitfalls throughout the presentation, and excited to be here with you today.
That's great. I appreciate that. This is a really a team that has a lot of experience in this space, and I appreciate you guys being here today. I appreciate our viewers tuning in, and today we're going to talk about a few different things. Obviously, we're talking about ASCs, but we're going to provide a little bit kind of general market overview, kind of what we're seeing, what we're working with some of our clients on, talking about ASC partnerships and developments of ASCs, thinking about preparing for growth of those ASCs, whether it's new development all the way through maybe adding on additional sites, whatever it may be, in terms of what that growth looks like. And then we're going to talk a good bit about transactions, as Andrew alluded to in his experience, as well as Richard and Wendy, thinking about like, what does that look like, when to start preparing, how to prepare, what to think about, some of the different factors, obviously talking about, valuations and things like that. So we're going to dive into a number of different things. As we do that, quick admin note, if people have questions, you can submit them via the chat. So feel free to input questions, and we will try to make sure to get to all of them. If we can't, we'll make sure to get to them after the fact. We're also going to have some polls that we do that we'd like to get some of your feedback along the way. So with that being said, I'd like to kick off our discussion with an initial poll question. So there should be a poll question on your screen. I'd love to get your feedback. We'll give you guys, 20, 30 seconds maybe to respond, and we'll get some results coming in, and hopefully this will help guide some of the discussion as we dive deeper into the material. So we're talking about what are the primary focuses, or what best describes an organization's relationship as it relates to ASCs. Do you own ASCs? We're exploring maybe developing an ASC. Maybe we're a system that owns ASCs or has joint ventures on ASCs, depending on which part of the country you're in and the different regulatory constraints that there exist that may dictate some of that. Or maybe you're an investor group and you're coming from that perspective. So results that I see here, okay, it looks like the majority of the group are representing folks that own or operate one or more ASCs. And we have some investor or PE-backed ASC activity as well, and as well as others. So that's actually really helpful. Obviously we know there's been a lot of growth and evolution as it relates to the ownership of ASCs, the development of surgery centers, and want to kind of start with like what are we seeing? What does that look like in the marketplace? Maybe Wendy, I may toss this first question over to you and think about like, what are we seeing? If you give a broad stroke of the current market landscape as it relates to ASCs, what are we seeing? What are some of your observations that might be helpful to listeners?
Sure. Well, I think most people know that the popularity and the appetite for ASCs is growing. At the same time, and I think we're at over 10,000 across the country based on some of the latest results from Definitive Healthcare. But at the same time, there's a number of struggling ASCs, right? And so what we've seen over the last 5 to 8 years as the disposition of ASCs, the people change in their careers, the owners are changing in their careers, what we're seeing is more and more the need for a strong strategy around A, performance and optimization, and B, so that you're prepared if there's an acquisition or any activity that the owners decide to make over time. Very easily, obviously, the patients enjoy the simplicity of the ASC. Surgeons generally have higher productivity in ASCs. Outcomes have been strong. And we are seeing much more flexibility and support from a payer standpoint. So over the last 3 years specifically, we're seeing the payers supporting higher and better rates in ASCs than they were before. We think that's because they're learning more and more about the metrics. We're seeing more and more that the cost difference between the hospital and the ASC. So from a Coker perspective, we really focus on two things. If there's a healthcare and hospital system, we're saying we really want to get an ASC strategy in the system. The ASCs are only continuing to increase in utilization. And two, if you're not a healthcare hospital system and you're privately owned or PE backed, we know how critical that is to long-term strategy and financial success. We know those facility fees and the success in patient care tie into your long-term success. So our big message is don't wait for that performance to happen. Focus on what we need to do now to optimize it. We'll talk more about that throughout the presentation. But we're just continuing to see strength and momentum for ASCs and a continued support from the payers. And we predict we should have more financial profitability than even in the past if you're comparing in-network rates to in-network rates. So, and that's why we're really excited to connect about it. It's definitely a movement that's not slowing down.
Yeah, and I want to touch on the ownership piece briefly, and I'd like to talk. We're gonna dig a little bit deeper into some of the transaction activity and particularly from the private equity side of that interest. But before we do that, maybe talk just briefly, if you don't mind, Wendy, about the kind of build versus buy, or kind of the earlier stages of thinking about ASCs, right? If we're thinking about, we're a group, whatever specialty it may be, we're thinking about developing this center or maybe expanding existing space or, existing network. What does that look like when you're working with clients and you're thinking about like build versus buy, and also tying into that the health system angle, right? If we're talking about joint ventures or different kind of alignment opportunities as it relates to these centers.
Yeah. It used to be the trend was really you would see surgeon owners specifically kind of hop from center to center based on the profitability of that facility. And I think most of us recognize that facility revenue is critical for any professional to offset, especially the decrease we see in professional fees over the years. And so I think what's happened is 3 to 5 years ago, we used to see much more hopping to different facilities in order to get the highest and best margin and return for performing surgeries there, et cetera. That's really started to slow down. I think everyone realizes the importance of starting a partnership right from the beginning that can carry through to a transaction. And whether that transaction is coupled with a practice or serves for the facility on its own, right from the very beginning, from a planning standpoint, we encourage really thoughtful consideration to the strategy of the center. It's easy to focus on the near term. Let's focus even on the 3 to 5 to 8 years and what we want to do. So that early development, we really want everybody to focus on what are we trying to do here? When do we plan to have some type of event? Or is that going to be an organic situation? And then you organize your ownership structure, your partnerships, your operating agreements, completely knowing that we are seeing, you'll hear more and more, we're seeing more and more that ownership structure and the operating agreements and the exit entrance restrictive covenants, these are blocking deals all of the time. And so I think one of our main goals is to get that point across, knowing that early on, when you're developing it, whether it's a buy or build, either one, we're looking at that ownership structure right from the very beginning and how you're structuring it to make sure that we're we have the highest degree of profitability, and B, you're not shortchanging yourself from what the future may hold for you and what you want to do in that surgery center.
Yeah, so I think that's great. Thinking about the long term, or at least the near term, from the get go, right? And
Yeah,
so
absolutely.
as you're thinking about that early on, thinking about what could an exit look like, and it may change. Obviously, it's going to evolve, and market shifts and things like that are going to dictate, ultimately which direction you go. But I think that's a good segue. And Andrew, I'd like to bring you in with your background in working with financial sponsors, private equity, or PE-backed entities that have continued over the last, really, couple decades, but particularly in the last 5 to 7 years, the growth of activity in the ASC space when it comes to PE sponsors. Maybe just start with, like, why do you think, what's driving the interest of investment in this space, particularly from a PE-backed perspective?
Yeah, I think the interest is driven kind of largely with what Wendy said. It's thematic around this shift to outpatient. I think everyone is seeing, that it's very expensive to perform healthcare within a hospital. It's there's the outcomes, there's the quality, there's the convenience of it all. Healthcare is becoming more kind of consumer focused, and I think the ASC itself, with the quicker recovery times, it's becoming a better option than spending a couple days in the hospital. Now, I think when the PE groups kind of sit down and think about, how can we play in this space? There's a limited amount of supply of the ASC. So what they're going to look for is, can I go out there and purchase, a handful, like the Summit deal recently with Wellspring was a decent example of 40 plus ASCs. And, that was a process where you got scale really quickly. Same with Constitution Alliance and Welsh Karsten, but they're saying, what other ways could I play in the ASC market? I think by doing that, you can look into orthopedics, interventional pain, cardiology, ENT. If there's any group that doesn't have an ASC associated with it, they could still get a transaction done. But I think the first question from the private equity investment group would be, could I build an ASC or partner for one too? So, they're very strong profit centers. I think they produce a lot of economics outside of just professional fees. And when you look at, an example like orthopedics, groups now, or investors, are looking to structure around 50% kind of professional fee revenue, the other 50%, made up of probably ASC, and then the other ancillaries that can go along with it. So these surgical focused specialties have a big ancillary pool. And the idea is really, can you capture the leakage to really, capture the whole patient experience? Everything from, and I'll stick on orthopedics, but not just doing the surgery, but doing the surgery in your center, and then having the PT associated, and the DME, and everything else that goes along with it too. So I think those are main drivers of it. And I think there's a lot of different ways to play it. But I also think, from their perspective as well, is you're driving physician alignment when you do these deals too. So if you have an element of rolled equity in your transaction, and you're able to have the referral base of your physicians not referring out to hospitals or to other ASCs, but coming back into the one that's owned by the management services organization, it's just creating, alignment and kind of stickiness that you wouldn't see if you didn't have it in place.
Yeah. Yeah, that's helpful. And we'll dive into some of that discussion around some of those terms and the different deal structures here in a minute. But something you said kind of sparked a question for me. When you're talking about, we'll just stick with surgical specialties. You have ENT, ortho, derm, those are a little bit more straightforward. Wendy talked about the payer interest and the appeal to payers, and you talked about quality, Andrew, as well. I think those are trends we've seen now for a good while, and they're pretty compelling. What about, though, some of the other specialties that straddle the fence a little bit between, do we partner with private equity? Take OBGYN, and if you have a GYN center, right, but you also have the OB piece where that's going to be aligned more with the hospital or system, but your GYN ASC may be a little bit, kind of take a little bit different angle. speak, if you don't mind, to, and feel free, anybody to jump in here, as far as like, is it either or are there joint venture partnership opportunities to kind of, hey, we can partner on OB, but we can also partner with somebody else on GYN and things like that. And that's not just OB/GYN, but I think that's just one example.
Yeah, absolutely. I think the joint venture angle is very interesting, and we've seen a lot of groups doing this. I mean, they can get very complicated in nature. And I mean, we've seen as much as having 4 different partners in there with, let's call it the management services organization, or the MSO being 1, the physicians being 2. Number 3 is going to be the local health system or whoever they refer to. And the 4th could be a USPI or an AmSurg or Surgery Partners or a national operator as well. So I think it's different specialty by specialty, and there's multiple ways to do a JV, either way, but it certainly doesn't have to. And we've seen the surgery center operators too, again, Surgery Partners, AmSurg, USPI, be very SCA with Optum, be very active in acquiring smaller practices as well that did have an ASC in place, but not just acquiring the ASC, but also acquiring the physician group as well. And again, how they structure the economics on all that can change, but they're looking to control kind of the referral base and run referrals through entities that they own. So it's not one size fits all. I think for for the urology, the ortho, for ones that are more kind of very cut and dry, like this should be an ASC versus like an OB or women's group. They come in a lot of different flavors.
Absolutely.
I just add to that, Mark, that for those that are also participating in a practice, it seems like it's easier to transact with a facility without the professional fees. There's a little bit more appetite that you might be able to keep that separated, but it's very difficult to transact with a practice without the facility, especially if you're taking office-based procedures to a surgery center that the practice would have earned income on. And that's really what we continue to see as medical practices are going to market, that the buyers want that facility revenue. And that's where these joint ventures and how your ownership structure comes in is really important.
Yeah, great point, which is actually a good segue, because I want to talk a little bit about what that growth looks like, right? So, and I think this ties into what Andrew, you said, and Wendy, some of your comments, but we're going to have another poll question here, and it should come up on the screen, but we want to talk about like factors driving growth. So we'd love to get some feedback on what are the factors that are driving the most ASC growth in your markets? And this may be your organization specifically, or it may just be, kind of what you're observing locally in your market across different specialties, whatever it may be. We'll give you guys just a second to respond there. So as those results are coming in, I want to, Wendy, maybe throw it back to you on talking about ASC development, because again, we're going to talk about transactions, but let's start with sort of the beginning. If you don't mind, Wendy, talk about some of the key elements of launching, developing, building an ASC and maybe an ASC network, and you're thinking about long-term success. You talked about some of the things: operational, financial, governance, those types of things. And then maybe even speak to what are some of the pitfalls that we get into when it comes to the planning process and things that, commonly we just don't think about, or they're easily missed, slipping through the cracks.
Yeah, we used to spend quite a bit of time, and I keep referring to the 3 to 5 years versus now, because I think it's important, because I think as the physician owners become more and more educated about surgery centers, we are seeing things we're seeing a shift, and as the payers do. So it used to be that our planning process was how to create the most financially profitable and impactful ASC. And in doing that, we're considering surgical mix, we're considering payer mix, we're considering location, surgery types, et cetera. So the really around ortho, cardio, ENT, we've mentioned several of them, derms, plastics. We would say, listen, this is the optimal mix, where you have maybe some that have higher implant reimbursements and costs, but you've got a mix of lower revenue cases that are bread and butter, interventional pain, podiatry, et cetera. Some of the interventional pain, not all. anything without an implant generally is a nice bread and butter type of procedure. And when we would do that, our goal 3 to 5 years ago was really just to create the best strategy where you have complementary surgeons. Maybe they're all part of the same practice. Maybe they're all part of the same referral network community. We wanted to have the right mix of people in there and create a profitable center. And that has worked. And what that has done is it has reduced the amount of hopping around to go to the center down the street because they have a better distribution. So we've seen some, not to say that anybody would make a decision just based on that. Maybe they have 2 ORs that they get to use, et cetera. But we've seen some containment where we're seeing less of that. What we see now is physicians coming to employment right from the beginning saying, hey, when am I going to have ASC ownership? What's that going to look like, et cetera? And it really has to be baked into the practice philosophy. For the development side, for specific to the ASC, how you're structuring your restrictive covenants, how you're structuring your entrance and exit strategies, as I mentioned before, those all really need to be factored in. I think Andrew and I can think of a half a dozen off the top of our head where we've had transactions go to market and it was for the professional side, but of course they really wanted the facility income and they couldn't get it because of the way that structure was. So whether you've developed it already or whether it's in development, we need to combine the two. We need to figure out the maximum optimization for utilization of the ORs, best income, et cetera. And then we need to be thinking who's aligned with the exit strategy down at the end. And I encourage those conversations early on because the concept used to be that you could have a practice and maintain ownership of the practice, and ASC was a great way to have a bunch of partners because you still have the practice. But because a lot of times your positioning of the practice is dependent on that ASC, we need to be having those conversations early on in the planning process. And if we've missed the boat on that, that should start happening now. And that gives everybody the time to course correct before there's an event, ideally.
Well, I think that's a great point because I think a lot of times it's easy to overlook the relationship to ownership and how a facility is structured in terms of ownership to valuation. And we're going to talk about valuation here in a second. Real quick, I want to close the loop on our last poll, and looks like some of the responses, the majority of the responses actually were thinking about shifts of procedures to an outpatient setting, as well as physician demand for ownership, payer incentives, and alignment initiatives as well. So that's pretty consistent, I think, with what we're seeing broadly in the market, which again is a good segue to, and Richard, I'd love to bring you in, and I'm going to open up a little bit of can of worms here. We're going to get maybe not too technical, but I know front of mind for anybody listening is thinking about valuations. And I love, Wendy, how you teed it up here as it relates to the impact or the downstream ripple effect of ownership and cap tables and structures and even regulatory structures and regulatory influences, how they could potentially affect valuations. So Richard, I'm just going to throw out the concept of valuation and thinking about fair market value, because there's regulatory concerns. And then there's also kind of what I think, Andrew talked about earlier is just sort of like market comps, if you will, or market, trends and the impact of those trends on valuations. And while we may not get into the ins and outs of the technical process for valuing a surgery center, that's a whole different discussion. But I'd love to hear kind of your perspective and all your experience working on FMV and litigation matters as it relates to transactions involving surgery centers, if you can speak to that a little bit.
Yeah, certainly, Mark. I think what might be helpful is, and we're going to stay at a high level, but hopefully give everyone a few things to think about as you're considering transactions. First of all, what is a valuation? And when I talk about this, I really like to describe this as it's a story at the intersection of benefit and risk. And when we think of benefit, it's usually some cash flow driven by some top line revenue number, which is going to be a rate and a volume. And then risk in its purest form is really just uncertainty. And that uncertainty, as we're looking at a transaction or an entity, can rear its ugly head in a number of different scenarios. But from a valuation perspective, what we're really thinking about is, um, are you going to get what you thought, that benefit level, when you thought you were going to get it, for the amount that you thought you were going to have to spend to get it. And so when we think about risk, that's kind of a broad brushstroke way of thinking about that. And there's lots of things that can interplay within that, but the valuation is looking at that and that intersection. There's lots of reasons why folks get valuations. And some of that, Mark, is I think you alluded to, and others may have alluded to, is really who are the participants as part of that transaction. If it is in some level, if it's a physician buying in from another physician, that's one type of scenario that we may be dealing with. If we have different parties on the joint venture, hospitals buying into an established ASC with physicians, well, now we have some regulatory constructs that we have to deal with and to make sure. That's often very interesting because if we look at comments from the government, on one hand, they have historically been concerned about is there undue financial benefit for physicians from their investment, yet at the same time recognizing and publicly stating how valuable and how necessary ASCs are as a place of care because of its efficiency and quality. And I think a number of the characteristics that Andrew had indicated earlier. But when we think about that, especially the valuation process overall, just from the diligence that we do at the valuation level. And I will state that when we look at those valuations and we look at financials, it's not the same as a true financial due diligence, but it can uncover some foundational questions. Again, we're assessing risk about operations. Some of those may be very simple, like looking at historical. Were all of the distributions in accordance with ownership interest? Is it practical that they would have met their 1/3 test? So there's some things there that we want to think about, but ultimately it's about return to that ownership level of interest. When we think about, again, at a very high level, the FMV process, probably most on this session have probably heard the different approaches, the asset, market, and income approach. Most of the time, because ASCs are they develop a nice return, we're usually looking at an income or market-based approach. And when we think about that, part of the due diligence or assessing the opportunity, and we'll mention some of those opportunities on a broader scale here momentarily, but looking at what the reimbursement rates that ASC is getting. I mean, there are sources out there, Datarize is one of them, where you can benchmark some of your reimbursement levels. But when we think overall at looking at how value is driven, almost any business, and this holds true for ASCs, just give folks a thought of a couple of key things to think in mind. One of those is size, all else being equal. And I think Andrew talked earlier about a number of transactions that were of significant size. All else being equal, greater size tends to correlate with greater value. The growth opportunity. We have, I think, as an industry, we're looking at potential for significant growth in the industry overall, where some trends are leading, but also within specific markets and for specific ASCs. A couple of others that are really more financial measures: how liquid, what's cash, how profitable is that organization, how effectively are they using their assets, and then, quite frankly, financial leverage. What kind of debt level that they have. So those are some key, just if we think about value, some key items to keep in mind. One of the things that I have seen in my career, both from reviewing projections that are provided by clients or working with clients to develop those projections, or reviewing countless other valuations, is one of the biggest things that I think gets missed or not appreciated to the level that it should is capacity constraints. Every business has one of those, and there's their chief driving capacity constraint, and that is dismissed. There's only so many ORs. There's only so much operating room time. The growth that you're expecting, can that be supported by those capacity constraints, including staffing, what other investments that might need to be made? When we think about this, we often hear ASCs in terms of different multiples, and we're not going to get into multiples as part of this conversation, but just think about that from we're in a different marketplace, and where we're going forward is very different. Wendy kind of talked about some of the trends with regard to payers, but when we think about from a regulatory perspective and reimbursement perspective, if we look at some of those trends, ASCs are looking more and more attractive, and even more so than they were. We're talking about a number of new codes that are being added to the ASC approved list. We're talking about the potential elimination of the inpatient only list, again, driving volume. Now, we may have to deal with expansion of site neutral payments along those lines. So when we think about those historical transactions and where we may be going, we need to think that those could be different markets, and we may have to adjust those as we're thinking about that. Finally, I would say, as we think about value, as you're entering into a transaction, and we've kind of talked a little bit about this, but being very direct about this, I think one of the biggest things is some of that uncertainty is having clean financials, making sure that what is being presented correlates with what you're doing, and so that you eliminate, are these financials, are they truly representative? Make sure those are clean, and again, it's a consistent story in terms of what you're telling. Not only benchmark what you're getting in the door, but how effectively are you collecting it? There's what you could collect, how effectively are you doing that? So looking at your revenue cycle, some benchmarking there, making sure, again, you're aware of your capacity constraints and understand what costs will I have to fund that growth. And then the last point I'll say is, if your story has another chapter, perhaps you're adding in a new provider, or perhaps a new, maybe it's multiple providers for a new subspecialty in there. Make sure that as you add that in, that it correlates, and it makes sense with regard to the rest of the story. Because unlike some kind of horror novel where you expect some crazy twist at the end, you want your valuation to be consistent, leading to a logical conclusion of value.
Which, yeah, 100%. We don't want that twist at the end, right? The idea, and it goes back to Wendy's points about thinking about valuation literally at the beginning, right? And it may not end up exactly kind of how you map it out, but try to avoid some of those surprises and twists, which is again a good segue, because you opened up a lot of different things there. I mean, the regulatory factors, the strategic factors as it relates to growth, even just some of the financial things as it relates to good financials and records and things like that. I think those are so critical, and the more you can think about those things early on is, I think, just telling to the success of some of the deals that we've seen, which again is a good segue. If we can bring up the next poll question, I'd love to see, like, how confident are people as it relates to, like, your organization's understanding of FMV and the different things that go into that, particularly or specifically for a transaction involving an ASC or some sort of ancillary services. What some of those dynamics are, as we're bringing that poll up and getting some of the responses in. I'd love to toss the question back to really the whole panel, as far as speaking to the importance of thinking about valuation, whether it's from the very beginning or along the way. When do we start thinking about that? And Andrew, maybe I'll start with you. Like, I'm sure one of the most common questions you get is, what's a good multiple? What's a multiple for the, I got this, and this, what's a multiple? Like, versus what Richard just talked about, which is, it's so much more, there's so much more to it than that. Speak to that question, if you don't mind.
Yeah, of course. I think what we're seeing now is, like, obviously there's been these big headline deals with, AmSurge and Ascension and the multiples around there. And that's a way different thing than a single site, single specialty kind of ASC here. I mean, I think what we're seeing more on kind of the valuation side, at least in the M&A processes, is it's valuing the entire practice, the ASC and the ancillary streams together. So does it affect, there's the earnings, the way that these deals will typically work is that people will value the company based off of kind of the net earnings, or the earnings before physician compensation. And a lot of times they'll apply a multiple, to a certain percentage of that. So I think when they think about the ASC component, they're going to, they've seen the private equity community especially has seen enough deals that have came across. They've diligenced them. They've hired market study providers where they know exactly what to look for. And they're not just going to be looking at the profitability of the surgery center to determine the valuation. They're going to be in the weeds looking at the procedure codes, the referral patterns, how stable they are, kind of all the key kind of KPIs that are necessary too. So I think you need to show growth within kind of your current, pathway to growth. And the other thing is you need to maximize out kind of utilization of your facility. We've worked with a number of clients right now who are, like a surgery center just opened. They're, getting patients running through it, but it's not nearly at 100% yet. And I think what you really need to think about is, should we take 6 months, 12 months to really kind of have that hard data and those numbers showing, because every, additional patient we get in is going to have a EBITDA multiple kind of applied to it on the go forward basis too. So not to rush into things right now, but I think kind of the preparation and the upfront analysis and the comparisons with, market rates that Richard was talking about are only going to drive up kind of the valuation. And I think, again, people are finding different ways to play the ASCs. There's not that many out there that are owned by a single person and like they're producing crazy amounts of money. So that's where it comes into play, where you're looking at urology, cardiology, vascular, all sorts of different areas too, to have that exposure, but also have the referrals kind of to drive through it.
Yeah, I think it's interesting, and with those comments and the poll results, 50% of people listening said they're very confident in kind of understanding what FMV looks like, right? And then another 30 to 35% said somewhat confident. Just under 20% said not very confident, which I think is fairly consistent with what I would have guessed. There's like a basic understanding of kind of what goes in, and there's a lot of that, just what multiple can I apply to my EBITDA, right? And you mentioned earnings before physician comp, and that goes into structure, particularly when it comes to private equity. But more hospitals are doing some of those similar types of structures as well on their deals. So I think that's very interesting. There's so many nuances to valuation, but when you're thinking about like, okay, where do we get started on really understanding the value? Like, you can't just put name the number multiple on our EBITDA, and EBITDA, that in and of itself is broader discussion as well. Where's the place to start when you're thinking about valuation, and whether you're just starting up, or maybe you're going to market, or you're looking for an active buyer? Where's the place to start?
Yeah.
Want me to grab that? Yeah.
Yeah, go for it, Wendy.
I can start with that. I think Andrew and I have worked with quite a few practices and surgery centers, and what has been killing us in these deals is when the financials don't accurately reflect the potential or performance of the center. And so right off the bat, one thing that we generally are encouraging is, if you think there's a chance you're going to go to market, get some professional help to make sure that your financials are accurately articulating stuff like implant costs, anesthesiology, really breaking out the income and making sure that we're setting the story for that evaluation, because that is what they're looking at. And then Andrew spoke to capacity and utilization. A lot of times people have 2 ORs sitting there not utilized. And most of the time that's just because the complexity of bringing owners to the table and figuring out who you want to partnership with and who you want to partner with. Spend the time to understand your current value and what it can change, like if you bring in another partner, et cetera. Or not. And really, just because the most painful part is when you see a group that's ready to have a transaction, but we don't have our ducks in a row, and we're not showing the narrative on paper the way it should. We have poor RCM performance. Our turnover in the ORs are too slow. We just haven't had the capacity to utilize. So probably my biggest components really that I would recommend as we go to market and create some value is making sure that the narrative is clear through your financials, having a serious valuation discussion, even if you don't move forward with a formal business valuation, about where your loss is, and then start getting it fixed. I mean, just start fixing it, because there are some nuances to saying, hey, RCM wasn't performing well, but that is not a slam dunk. In other words, we're finding, hey, RCM isn't performing well. They produced this much. They should collect this much. We're not necessarily seeing that. So really, time is of the essence to position yourself properly and not kick the can down the road, so that your narrative is accurate for what you're actually producing.
Yeah. Go ahead.
Wendy, I would add, yeah, I agree with all of that. I think what we see is more kind of on the private equity side. If we were selling a platform for a private equity group where there was already institutional capital,
Yeah.
had a management team in place to look over the numbers and kind of, have everything kind of ticked and tied and be ready to go, which is why they interview advisors. They already know kind of what's going to happen. I think on the independent side, though, I mean, yeah, start thinking about it 12 months before. I mean, those for us, for a large kind of independent group, we would, if you were just to walk in there and say, okay, let's hit the market, you leave so much value on the table by not optimizing the things you should. I mean, the buyers are going to request all that data anyways, but can you clean up the P&Ls? Can you have additional structure around your ASC or around your collections, your RCM? And then can you do a quality of earnings report and kind of normalize out the financials and get credit for add backs and build out a financial model too. So yeah, I think it's just ultra important for the independent groups to really understand that it's not snap your fingers and we have a deal in 3 months. Like, you really need to extract maximum value. You need to spend that upfront time to get everything in place.
Yeah, I mean, we could have a whole different webinar on, MSOs and the development of management teams and operational infrastructure, things like that. And we've been involved in transactions where groups may have already been talking to interested parties, and they literally, during the deal process, that's when they start thinking about, okay, wow, we could implement an MSO and build up a management team, whatever it may be. And sometimes it happens after the fact. But I think, again, going back to Wendy's earlier comments, thinking about that stuff up front, it has an impact. I mean, you think of staffing and overhead and the impact on valuation models that would have, which is, again, a good segue to our next question that I want to throw out there for a poll. But Wendy, you talked about this. Andrew, you talked about it as well. When we're thinking about potential partners, what are the biggest factors that are being weighed when you're thinking about, do we want to go this route, that route, or maybe another route? And then within each route, what those partners could look like. What are we looking for? Is it financial return? Is it autonomy? Is it, infrastructure? Is it growth? Whatever it may be. So I'd love to get the viewers' feedback on that. While we're waiting for that to come in, Andrew, maybe if you don't mind, talk a little bit about what are PE sponsors specifically. What are some of the things that you're seeing that they're looking for, that they're interested in?
Yeah, they're looking for alignment. They're looking for, strong market leading margins, and they're looking for a pathway to growth. I mean, and those are just 3 quick things, but I mean, the whole kind of antiquated nature around private equity is, counting paper clips and kind of cutting costs. I think what it is really these days is really more about growth. It's, if I invest behind this group in this ASC, how can I really kind of expand it? Just, even from a financial perspective or just a patient population and care perspective as well. So it's not about cutting costs. It's really about growth and telling that growth story. So, I mean, I mentioned before, but they've spent so much time and money kind of looking at these sectors that they're going to understand, exactly what your utilization should be, or what your drug cost should be, or medical supply cost should be too. So I think just generally having data is going to be very helpful. And I think depending on the size of the organization, going back to outcomes, I think collecting outcomes data and understanding that if you scope a knee in an ASC versus in a hospital, you're able to save, the insurance cost, or there's just general savings in place too. I think a lot of healthcare is growing. I know it was a bigger issue a couple of years ago talking about value-based care and things like that, but can you have real hard data that you can take to the payers to negotiate better rates and say, our patients, when they go through the doctor or through our facilities, have, 4 or 5 days quicker to get back to their regular life, or things like that, that limits the cost too. So collection of data, collection of outcomes, clean ownership structures as much as you can. Try to, limit the complexity of, all the physicians are going to want an ownership piece of an ASC, but, is it owned by 3 groups? Is it owned by 5? Do we have we had the legal conversations to understand how we can unwind this? So, I mean, I think those are factors. And I mean, the other thing too is, like, we didn't talk about it before, but kind of thinking about certificate of need and kind of the regulations around that too. I mean, if you are in a CON state and you've received a license, there's value to that, even if you haven't built. So, and that goes into what Richard was talking about with valuation too, but really kind of avenues for growth. But
yeah. Absolutely. Once again, probably something Richard could talk about for the full hour as far as just looking at the value of CONs and how to even assess that. But, as we think about, we have just a few minutes here. I want to bring us full circle and respect everybody's time. Again, I appreciate everybody tuning in. But, as we think about, like, what are some of the key takeaways? What can people thinking about the stuff we talked about today or any of the related things, which, there's a lot we weren't able to get through in less than an hour, but, what can they start thinking about today to start preparing for whatever it is down the road, whether it's a transaction with private equity, whether it's joint venture with other groups or with a hospital system, or whatever it may look like, bringing on new owners, organic growth, whatever it may be. I'd love to hear from each of you is just, where do we kind of start, regardless of where we're at today, where do we start? And what are some of the key things we should be thinking about for whatever that end goal looks like down the road?
Maybe I'll start
Please.
highlighting a couple of key items. I think we talked about going back to we've used the analogy a little bit, or at least I have, with regard to a story. And value is directly correlated to that intersection of business, of benefit and risk. And we've talked a number of ways about clean financials and the structure. The greater the complexity, the greater the risk. The less clean your financials are, the greater the perceived risk. So some of this is, as we've, I guess, a key point would be is to make sure you know where you're at and what are some things that you can do. There may be some low hanging fruit. I call it spring cleaning. Do some spring cleaning, and then there's more advanced issues that Andrew and Wendy were talking about that can also add value. But make sure that you've got your story clean and that the information, as Andrew was highlighting, the stuff that you're sharing with your advisors are the things that the other people on the other side of the transaction are going to get and diagnose and look at. So you might as well have your story straight and put your best foot forward when you go through with that.
Great point. Andrew and Wendy, as you guys chime in, I'd like to bring up our last question of the day, which is just thinking about what we talked about today. Again, knowing that there's a lot more information here that we weren't able to get into, where folks feel most motivated to take action, or at least start thinking about as it relates to potential transaction or an ASC strategy, regardless of transaction down the road. But Andrew, Wendy, I'd love to get y'all's input on that as well.
Yeah, happy to. I know we've covered a lot of this. I mean, I would say kind of, just focus on kind of the physician ASC component and really kind of helping them, whether it's physician education. I assume there's a number of administrators on here too, but showing them the importance, both financial and, outcomes and everything else, just the stickiness that you can drive by, controlling kind of your referral patterns and sending things to your own ASC. So I think everyone, or most of the physicians, probably understand like the financial benefits from this too. But we do see a lot of times in smaller practices that will have an ASC component, or they'll have a physician that owns 3% in the local USPI facility too, and they're not sending them somewhere because it's closer to their home. I just think kind of the referral methodology, it matters a lot. So I would have those conversations early.
Yeah,
Absolutely.
I love that. I think the only things that I'd add, and I've talked about the importance of partnership structure at the beginning. Most common mistakes, we kick the can down the road because we have so much going on, and there are so many aspects of running an effective surgery center or surgery centers. Invest the time professionally and financially to get the right team in place, to be making sure that you're capturing the maximum productivity and best strategy now, and positioning yourself for sale. So kind of my call to action is It is painful to see when owners do not achieve the best outcome because there was so much opportunity in the meantime. And it goes back to Andrew's point. Spend 12 months really increasing and working and focusing on it, because the reward is worth it at the end, for sure.
Absolutely. And, I think it's interesting. I mean, the majority of the feedback from the last poll question was focusing on readiness and structure. So I think that's something that everybody knows is going to be a factor, but sometimes that's the hardest thing to hone in on. I think, when you think about throughput or capacity or some of the other things we've talked about, overhead, whatever it may be, those are things that may be a little bit simpler, maybe not easy, but simpler to digest. But when you're thinking about just like structuring and sort of that long-term strategy, I think that's critical, and it all impacts valuation. So if valuation is important, which of course it is to everybody in these situations, then that's going to be something there. So we're about at time here. Again, I want to be respectful of everybody's time. I really appreciate everybody's participation. I appreciate all the attendees, and again, I'll just remind everybody, if there are additional questions, or if there's any additional information that we can provide, we have that information available on our website, cokergroup.com. But please feel free to reach out to any of these panelists. Happy to answer any questions or provide any more in-depth information that we weren't able to get into today. But with that, I appreciate everybody's time, and I hope everyone has a great weekend. Thank you very much.
Thank you.
Thank you.